If you opened a terminal before sunrise on Feb 4, this was not a routine dip. It looked like the start of a supply standoff, and the timing mattered. The screen showed one price, while the physical market hinted another. When those two split, things get tense. That split is the signal. Producers have one lever that matters. They can slow sales. They can hold inventory and wait. That decision hits refineries first. Overnight, talk spread that several primary silver miners might pause spot selling. Even the rumor can move the structure, markets price expectations. In this video, we break down how a producer pause works, and we do it with math you can verify. No secret sources needed. We'll also map the indicators to watch over the next sessions. So you can respond, not chase. Stay to the end for the checklist. Before we go deeper, hit like and subscribe with notifications. It helps this reach traders before the next move. 2 clicks, big impact. Here's the core. Paper can multiply fast. Metal cannot. A quote is a promise, a bar is a limit. Supply sets the ceiling. When promises outgrow deliverable supply, confidence becomes collateral, and confidence can vanish quickly. That's when volatility explodes. Futures markets are designed to net positions. Most contracts end in offsets, not trucks. That's why volume looks endless. That's fine until more buyers demand delivery. Then the system must source real metal. Delivery is the stress test. That's why warehouse labels matter. Eligible meets specs, registered as tagged for delivery. Both are reported regularly. Registered is not the same as free. Some of it is already allocated or leased, and it can be reclassified overnight. The refill pipeline keeps registered from shrinking. Refiners and shipments replace what leaves. Watch the receipts column. If producers slow shipments, the market loses timing. And timing is everything in just-in-time supply. Factories run on schedules. Recent reports put deliverable inventories in the tens of millions, not hundreds. Open interest can represent far more in paper claims. That mismatch is the risk. One contract equals 5,000 ounces, so 70,000 contracts is 350 million ounces notional. Not all are active months. Only a slice asks for delivery, but the slice matters. 5% is big, 8% is bigger. Even 3% can bite. Now factor in the true free float. If only part can move, the cushion thins fast. Free float is the hidden metric. This is why miners talk about all-in sustaining cost. If spot is under cost, selling destroys value. Costs include energy, labor, and royalties. A company can't run losses forever. Shareholders eventually demand a change. Cash flow is oxygen. The change can be quiet. Hold bars, delay sales, redirect to contract buyers. It doesn't need a headline. Some sell through offtake deals. Silver supply is also tricky because much of it is byproduct. Primary silver mines are not the whole tap. That limits flexibility. Byproduct ounces don't surge just because silver spikes. Base metal mines follow their own economics, so response can be slow. Demand is not just investment demand. Silver is used in electronics, solar, and industrial contexts. Substitution is limited. Much of that use is consumptive. Once dispersed, recovery is hard and slow. Recycling helps, but it lags. Shortages show up first in premiums. The screen can lag the street price. Premium is an availability tax. If you want a reality check, ask local dealers 2 things. Premium, overspot, and wait time. Ask for bar quotes too. In past stress events, paper fell while premiums rose. Availability and price are different. That gap can widen fast. Why would a pause happen after a sharp drop? Fast sell-offs often come from leverage and forced risk cuts. One margin call can cascade. When that pushes spot below cost, producers feel it first. They mine real rock, not tickers. They feel diesel and wages, so they use their lever, the tap. Slow sales, build inventory, negotiate. That is basic leverage. We've seen versions of this across commodities. Supply discipline changes bargaining power. It's a producer playbook. Silver is not as concentrated as oil, but deliverable pools can still tighten. Tight pools create sharp moves. Small draws add up. Another indicator is the futures curve. Rising near-month prices can signal urgency. Also watch EFP and spread behavior. Watch lease rates and borrowing costs when you can. Higher carry often means tighter metal. Rising lease can pressure shorts. Watch exchange actions too. Margin hikes and rule tweaks. They calm heat, but also reveal stress. Rules are part of the game. None of this needs conspiracy language. It's plumbing under a paper-heavy market. Think mechanics, not villains. Treat company talk as a signal, not a guarantee. Plans can change overnight. Look for guidance, change in filings. Not every miner benefits the same way. Hedged output is capped. Unhedged output is pure exposure. Spot exposure is the key. If you study miners, read the hedging notes. Also check debt, energy costs, and jurisdiction. Read the footnotes carefully. Higher silver helps margins, but it doesn't erase operational risk. Floods, strikes, and permits still matter. Operations can surprise you. This is not financial advice. It's a framework for understanding flow and risk. Do your own research. Now let's make it practical with 3 checkpoints you can track. They'll tell you if this is noise or structure. Here they are. Block 2. Number 1. Warehouse trend. Track registered versus eligible and net withdrawals. A steady draw with weak receipts is a warning. Look for multi-day patterns. Number 2. Premiums and spreads. Watch coin and bar premiums plus ETF discounts or premiums. Divergence is often the first clue. Premiums show urgency. Number 3. Curve and leases. Watch near months versus later months and any lease rate spikes. Higher urgency usually has a reason. Curves reveal stress. Now add a key detail. Exchanges sell a settlement rulebook. They do not promise every claim becomes metal. The rulebook includes delivery options. If physical demand surges, the rulebook can push rolls or cash alternatives. That keeps trading orderly but can shake trust. Changes can move price fast. Trust matters because industry needs delivery, not debate. Manufacturers care about timing and specs. They hedge to keep lines running. Many buyers run lean inventories to save capital. Lean systems work until supply slips. That's why small shifts matter. When buyers fear delays, they order early and bigger. That can accelerate the shortage. This is how squeezes snowball. Silver is global, so metal flows to the best terms. Price, reliability, and logistics decide routes. Arbitrage can move bars across borders. If one venue is cheap but tight, shipments may shift elsewhere. Markets follow incentives. Freight and insurance set limits. Costs rise when grades fall and energy climbs. Mines must process more material for the same ounces. Ore grade is everything. That makes the marginal ounce expensive. If price ignores that, supply eventually reacts. Supply reacts with a lag. Another nuance, new mines take years to build. Underinvestment today shows up later as thin buffers. Permitting is a bottleneck. That's why long depletion cycles matter. The bill arrives when demand meets weak supply growth. That's why cycles repeat. Retail premiums also include fabrication and shipping. They can spike before wholesale bars do. Retail is a dashboard, not the engine. If tightness is real, it migrates upward. Coins to bars to refinery schedules. Watch where delays appear. The wholesale layer is key. Government mints can amplify the signal. Rationing blanks pushes retail premiums higher. Popular coins can vanish quickly. Paper quotes can look calm because liquidity is huge. Calm can flip if big players want delivery. One delivery month can shift sentiment. If you trade, respect volatility. Leverage turns swings into wipeouts. Risk management is not optional. A simple rule. Size your position before your entry. Survive the noise to catch the move. Plan the trade the plan. If you invest, separate metal from miners. Metal is a commodity. Miners are businesses. Stocks add management risk. Strong balance sheets matter in a volatile rally. Debt and hedges can limit upside. Quality shows in downturns. Also remember policy risk. Royalties and taxes can change when prices rise. Headline price is not net price. So what confirms a real standoff? Falling receipts, steady premiums, and miners guiding for inventory builds. Guidance language matters. It also shows up in industry commentary. Listen for talk of lead times and higher input costs. Procurement teams notice first. Verify with primary sources. Warehouse reports, filings, and official statements beat screenshots. Primary data keeps you grounded, but keep space for other outcomes. New supply can appear and demand can cool. Macro shifts can change demand. That's why we track indicators, not just predictions. Adaptation beats certainty. Stay flexible. Paper markets are useful for hedging. They still rely on trust and settlement. They also provide liquidity. If trust weakens, spreads widen, and collateral demands rise, that can lift price through higher carry. Higher costs can squeeze everyone. Practical takeaway, watch the plumbing, not one headline print. Inventory, premiums, curve, and producer behavior. Track daily, not weekly. Don't confuse speed with truth. Fast rallies and fast drops both trap people. Emotion is expensive. If you buy physical, favor trusted sellers and clear terms. Avoid panic buying at extreme premiums. Use limits and patience. If you look at miners, compare costs, reserves, and hedges. Seek survivability, not only leverage. Compare them to peers. Mixed metal producers can be steadier. Pure plays can be higher upside and higher risk. Know what you own. Now I want on-the-ground data. Call a dealer and ask premium and wait time. Tell us what they quote. Post your city and the product type in the comments. Skip personal details and keep it simple. Crowd data is powerful. If you work in procurement, share what you hear from suppliers. Lead times are a real signal. Keep it brief. Over the next sessions, watch whether tightness persists. Structural shifts linger. They don't flash once. Persistence is the tell. If inventories slide and premiums stay firm, price can reset higher to pull metal out. That's how clearing prices work. Clearing price attracts sellers. If receipts rebound and premiums cool, stress may fade. Either way, the data will show it. Then you reassess. Stay disciplined and stay liquid enough to adapt. An edge is useless if you get forced out. Avoid getting trapped. Hit. Like if you want more data-driven breakdowns like this, it tells the platform this content is worth showing, it keeps this channel alive, and subscribe so you catch the next update when the reports change. Drop your premium and wait time notes below. Share this with one friend.